Welcome back to Real Estate Mindset. You guys, we're going to go over some bonkers data right now. And today's video is going to be the fate of the housing market. And what we're going to stay really in, we're not going to really talk about the crash or possible recession. We're just going to look at the data as it pertains to supply and demand. Okay. So I'm fixing to bring up some graphs right now. And what I want to do is I want you guys to pay attention to the lack of inventory, because the lack of inventory needs to change before, in my opinion, before any cool down takes place. Now, remember guys, like this video, subscribe if you haven't already, and definitely comment, definitely understand I'm not a financial advisor. This is just my opinion, okay? So let's bring up the first chart right now. Now, what we're looking at is, we're going to go to this one first. We're looking at Freddie Mac's data here, and what this is showing is the monthly supply of houses in the United States. Now, obviously, now look at here. Here's really the beginning of the crash in 2008. You can see that we had a ton more inventory in the housing market in 2008, and that's one of the big reasons the housing market in 2022 is so different, is because we don't have any inventory. So the demand is crazy, but the supply is basically nil. But if you can see here at the peak of January 2009, there was a sharp crash, sharp decline. Now, if we go all the way over here till today, we can see that, historically, there's almost no inventory. This is a massive problem. So, that's the biggest problem right now. If you're buying, quite simply, there's no inventory, and the inventory that is available right now is complete garbage. And people are having to pay way overpriced for houses that they don't like. And the houses that are nice that come on the market, multiple bid offers, you can't get it. Consumers are getting frustrated, they're giving up, but there's still an overwhelming amount of demand because, quite frankly, there's no supply. So before we start seeing any type of cool off, we're going to need this, in my opinion, we're going to need this close to double. Okay, we're going to need to be way up here in order for any type of cool off to begin. And that's just kind of the reality of the situation, you guys. But historically, look at how low the actual supply of housing is. I mean, this is really astonishing. Now, I want to go over one other thing as well. Look at the active listings, okay? Now, this is going back to 2007. So, prior to COVID, we were way up here as far as listing. Now, and this is just the Woodlands, this is my local area. As you guys know, I'm a realtor in Houston, and I'm a loan officer in the entire state of Texas. So if you guys have any questions or want to engage a little bit more specifically about your specific situation, definitely email me. My email is in the description below. But look at this. So here's the active listings. And as you can see, as of 2019, plummeted. Look at this. Plummeted. It's gone up a little bit the summer of last year, but now it has also once again plummeted. Now, to me, this is especially surprising because generally when it's February and when it's March, inventory starts going up. And what I have been seeing is this inventory has not necessarily gone up. The demand is still red hot. So, what we have going on here is we have a lot of factors that are kind of demonstrating that there should be a cool down, that there should be a crash. But quite frankly, we have supply and demand hitting each other, and it's constantly competing against each other. So right now, as we're going into 2022, the housing market is red hot. Okay, it is red hot. That is undisputable. One of the reasons why it's red hot, quite frankly, and in my eyes, the strongest reason why we have a red hot market going into 2022 is the lack of active listings. And as you see here, historically, the lack of supply. So really astonishing, you guys. That's a really scary number. For some of the people that have been waiting, like myself, I've been waiting for a cool down. That's a scary number. That number shows me that we are nowhere near that cool down yet. But let's look at the other factor. Let's look at the demand. Now, one of the reasons why we have such a high demand is because the affordability, right? So for the last couple of years, there have been really low interest rates. On top of that, there have been quantitative easing and a whole bunch of stimulus. There's PPP loans, EIDL loans. Now, here's a fact. No more stimulus, no more PPP loans, okay? That is gone. Quantitative easing is being taken out of the market here shortly. The Fed is going to meet in a couple of days. Now, here's what we're really going to get squeezed on, okay? Inflation, okay, is one thing, but look at the 30-year fixed rate mortgages. Now, this is by Freddie Mac again. Now, as you can see here, November of 2021, rates were average rate was 2.98%. That is astonishing. Fast forward till February 17th, went up to 3.92%. That is a massive increase. Now, you see here that the rates went down a little bit, about 20 basis points as of March 3rd. To me, all that's showing is it's taking into account the Federal Reserve's new stance on how they should increase interest rates. And they came out last Wednesday and basically said, we're going to have a more dovish outlook on raising interest rates because of the war with Ukraine and Russia. So that doesn't mean they're not going to start raising interest rates. The reason I bring this up here is there's a massive surge of interest rates. And what that is telling us, guys, is affordability is going to start being diminished, okay? So when affordability is diminished with higher interest rates to combat inflation, mind you, so the reason why these rates are shooting up is they have to shoot up. Having the interest rates go up like that is actually a good thing, especially if you're a buyer and especially if you don't want a market crash. The longer, in my opinion, the longer the feds take to raise the interest rates, the more likely it is that we will have a crash and that we will have a recession. But here's the thing, with affordability dissolving and also with investors leaving the market, that is going to bring down the demand, okay? So what is happening right now as we start 2022 is we have many factors that is actually bringing the demand down because of affordability, because of the lack of investors. As you guys know from some of my videos, investors were a large piece of that pie when it came to purchasing homes. In certain metro areas, up to 50% of the houses were purchased by investors. But now that Zillow's out and institutional corporations are out and small-time investors are going to start leaving, the demand is going to be lower, okay? Affordability is going to be lower. So as we're going into 2022, what we need to start seeing in order for a cool down to take place is we're gonna need to start seeing more inventory. And really, you guys, the whole market has been propped up by resale houses. Until we start seeing these new home builders start completing their houses and putting them on the market, in my opinion, we are going to be stuck in this very toxic seller's market for quite some time. Now, as you guys that follow my channel know, my anticipation is the fourth quarter, the very end of this year, the cool down, possibly crash will begin. Now, that depends also on the Federal Reserve. If they raise the rates too quickly, which I don't think they will, that will obviously, it will lead to a faster cool down. But as you guys saw from these graphs, quite frankly, we don't even have enough supplies for there to be a cool down. Now, as you saw in one of my videos, as of 2021, there are 1.5 million new build permits that were pulled. The problem is and why we're seeing such low inventory and such low active listings is the supply chain disruptions. If we didn't have these supply chain disruptions, new builders would be able to spit out these homes and get them on the market. And what that would do would be increase supply. So one thing to watch out for if you're in the market like myself, if you're waiting for a cool down, is we're gonna need to start seeing less disruptions in supply chains, which is going to be really difficult because of the war in Ukraine and Russia. So we're going to need to see these builders start kicking out these houses again, and we're going to need to see more inventory, because regardless of affordability diminishing, regardless of investor involvement, quite frankly, the prices are still going to skyrocket in my eyes because there is nothing on the market. And again, you guys, the stuff on the market is really bad. Now, I saw a home on the market come on the market today that I know is overpriced, but I love it. So I'm willing to pay extra for that house and hold on to it with 7 to 10 years because I actually love the house. But probably what's going to happen is we're going to look at it, we're going to love it, we're going to put an offer in, and it's going to get rejected. So consumer confidence is also low as a result of the over offers and the bidding wars. But you guys, what I want you to do is really think about this data, because if you are expecting a crash or cool down to happen in the spring or the summer, that's not really realistic. How can there be when there's no supplies? And the other problem is I believe there's a bunch of pent up buyers right now, a bunch of buyers that are holding out for the cool down. So don't expect that to happen in the next 6 months. Again, I go back to my opinion, which is probably at the end of this year, we're going to start seeing things cool off, possibly crash. Anyways, guys, I hope this data helped you. I wanted to do a quick video on the state of our market and where we're at right now, instead of predicting a crash and all this pandemonium and things like that. So I think right now, if you're on the market to buy, just wait for a home that you love. There's a small window as far as interest rates dropping a little bit, but that's just a little bit. As you saw, once again, let me pull this up. As you saw, they're still higher than they were, right? We got 2.9 over here. They dropped down a little bit, but not much, you guys. That's not a huge drop off compared to where we were, in November. And look at this, even lower, August of last year. So they're still higher comparatively from a one-year comparison. But overall, the fact of the matter is we're still at really historic low interest rates. But that is probably going to start changing. The Fed is going to probably continuously going to raise the rates throughout the year, probably up to 6 times. Anyways, you guys, as you know, I always appreciate you. Like this video, subscribe to my channel, all right, and follow along with me on this journey. And until next time, good luck out there, and I hope you win.